Take a look at the position of call option buyer. Before we do that, just a quick reminder that an option contract is a derivative security that gives the holder the right but not the obligation to buy or sell an underlying asset. In our case, that underlying asset happens to be foreign currency. There are two types of option contracts. You have a call option, which gives you the right to buy foreign currency, or you have a put option, which gives you the right to sell foreign currency. And for each type of these two options, you have buyer. So you have a buyer of call option and you have seller or writer. And for put option, the same thing. You have a buyer of put option and you have a seller or writer of put option. So this video is about buyer of call option. So this is about the party that buys the right to buy foreign currency. But we have videos on each one of the remaining three positions. So to make sure you watch them. So let's take a look at the call option buyer. It's best to work with a numerical example to see how this works. So let's say we're working on call option contracts on euros. So let's say contract size is 10,000 euros. So the contract size is 10,000 euros. Let's say the call premium. So this is the price you pay as a call option buyer to get the right to buy euros. Let's say the call premium is 10 cents per euro. ST stands for future spot exchange rate. So this is the exchange rate that will be at expiration, but we do not know what this is going to be. E stands for exercise or strike price. And in our case, let's say the exercise price is $1.30 per euro. So what this means is you as a call option buyer, you are buying the right to buy euros for the price of $1.30 per euro. Of course you don't have to, but you can. And for that right, you pay 10 cents per euro. Of course the contract size is 10,000 euros, so everything that we calculate on a per euro basis, you can just multiply that by 10,000 to get the total amount for each contract. So let's take a look at the payoff and profit at expiration. So remember, in the future, there are really three possible scenarios. So you could have future spot rate that is greater than your exercise rate of $1.30, or in the future, spot rate could turn out to be exactly the same as your exercise rate, or in the future, spot rate could turn out to be lower than your exercise price or rate. In that case, you have to figure out, okay, will I exercise this contract as a call option buyer? And then if so, what will be my payoff and what will be my profit? So remember, the difference between profit and payoff is that simply profit takes the premium that you pay into consideration. So let's use some numbers. So in the future, let's say future spot rate happened to be $1.50 per euro. So this is obviously greater than your exercise rate of $1.30 per euro. So the question is, will you exercise in this case? And the answer is yes, right? You always want to buy things at a lower price. So instead of going to the spot market and buying euros for $1.50, you can buy them for $1.30 by exercising your call option. So these call options are said to be in the money in this case. And your payoff is going to be the difference between $1.50 and the exercise rate of $1.30. So in other words, you can simply exercise your call option, buy euros for $1.30, turn around and sell them on the spot market for $1.50 and make 20 cents per euro, right? So this is your payoff. If I were to write a generic expression for it, it is the difference between future spot rate and exercise rate. As for profit, what we're getting is that you have payoff of $1.20 per euro, but you have to subtract the 10 cents you had to pay for this contract up front. So it is, your profit is actually 10 cents per euro, or in other words, if I were to write generic expression, it's the difference between future spot rate minus your exercise rate and minus your call premium. So in the future, what if spot rate turned out to be exactly the same as your exercise rate of $1.30? In this case, will you exercise? And in this case, why would you bother to exercise it, right? Because you can just go to the spot market and buy them for $1.30, so you will not exercise this contract. And these call options are said to be at the money. And since you're not exercising this contract, there's no payoff. But remember, you still had to pay for these call options, and so you're out 10 cents per euro. So in other words, minus the cost of the premium. But in the future, let's say if spot rate turned out to be $1.10 per euro, so that is lower than your exercise rate of $1.30. In that case, obviously you will not exercise this contract, because why would you exercise this contract and buy euros for $1.30 when you can go directly to the spot market and buy them for $1.10? So these call options are said to be out of money, and you obviously will have zero payoff because you're not exercising this contract. You're not doing anything, you're just letting it expire. But as for profit, you're still out 10 cents because you had to pay for this call option. So your cost is really losses negative 10 cents or negative C. Now let's take a look at your maximum possible profit. So what's the best case scenario for you? As you can see, if future spot rate happens to be the same as your exercise rate of $1.30 or lower, you are not exercising this contract. But if future spot rate happens to be higher than your spot rate of $1.30, you do exercise this. So obviously, higher the future spot rate, better it is for you. Higher profit, more profit you're going to make from this position. So since there's really no limit, there's no theoretical limit to how high future spot rate can be, what this means is then there's really unlimited potential profit if you are call option buyer. So there's nothing that says future spot rate has to be $2 or less, or $3 or less, or $300 less, etc. So there's no theoretical limit to future spot rate. So that means your future potential profit is really unlimited. So how about your maximum possible loss? As you can see, whenever future spot rate is not favorable to you, so let's say it's less than $1.30, you simply do not exercise this contract. You do not have to. With call option, you get the right to do something, but not the obligation, so you simply will not exercise this call option when the future exchange rate is not in your favor. All you lose is your premium of 10 cents. So the most you're going to lose is if you just let this option expire and do not exercise, and you lose your premium of 10 cents per euro. So 10 cents per euro. So you're really out your premium. So that's most you're going to lose. So at what future price or exchange rate will you break even? So this is the rate at which you make no money or you lose no money. Well, what you're solving for is at what future spot rate will the payoff be exactly same as the call premium, so that the positive payoff cancels out the 10 cents that I pay. So if I solve for the future spot rate from here, I see that at future spot rate of $1.40 per euro, I break even. I do not make any money. I do not lose any money. So if I were to put that in a figure, this is what the payoff profile of a call buyer looks like. As you can see, this is our price of $1.30 per euro, and this is our break-even price of $1.40 per euro. So we start exercising this contract once future spot rate passes $1.30. And after $1.40, we start making money, and there's no upper limit to how much money we can make. That's why this line is upward sloping. But for all future exchange rates below $1.30, we simply do not exercise this contract, and we simply lose our 10 cents.